Hey, what's up, everybody? Good morning, good afternoon, good evening. This is Anthony Rosa, the community finance coach, aka Mr. Remedy. And today we're talking about Money Monday. And of course, I have my buddy here, Kevin Shanman. Hello, say hello, Kevin.
Hey, everybody. Hey, Anthony. How are you, sir?
Awesome. So today we're going to be talking about, of course, as it relates to the market in real estate, credit. But first, Kevin, why don't you explain and introduce yourself a little bit more and what you do?
Absolutely. I'm the Vice President of Homeland Lending. I'm a loan officer, a loan originator. Homeland's a mortgage lender and a mortgage broker. I've been in the business for about 26 years. Started out on the big banking side as a wholesale loan officer. Ran my own business for about 13 years. Cornerstone Capital Financial Services in River Edge. We merged with Homeland about 2 years ago. And
Mm.
I help people buy homes. I help them get ready to buy homes. I coach them on preparing to buy homes. Obviously, I talk to them about repositioning their equity if they need to pull equity out of their existing homes for college, for retirement, anything to do with home, secure financing based to the home. That's what I do.
And it's really exciting, because this is an ongoing conversation for individuals, right?
Mhm.
There's no early stage, there's no too old stage to kind of get in,
Correct.
right? This
Correct.
this
Correct.
this dream or idea of buying a home, everybody should own their own home. And as it relates to credit, right? As a financial coach, I've been practicing working on individuals for over 9 years now. I think that the most important thing is always making sure that you partner up with the right individuals, number one. And number two, right before you're preparing for that finance request, if you feel like you're ready, and you have some money in the bank, I'd
Mhm.
probably start talking about lowering your credit card balances to zero. Right, Kevin? Kevin, talk to us and share with us from your point of view some of the reasons why people get declined. Let's talk about that derogatory remark area.
Absolutely. Mortgages, the mortgage approvals are generally computer generated. One of the blogs I did a while back is that there's a famous scene from, I think it's an old Disney movie, Mary Poppins. We have all these old gentlemen sitting around the table making decisions, and unfortunately, that's not really how it works. Underwriting decisions are made based on a narrow set of criterion. It's very automated. The underwriting software pulls your credit information from your credit report. You input the financial information, you put in the parameters of the type of transaction, and the Fannie Mae or Freddie Mac computer either says yes or it says no. Obviously, credit is a huge, huge, huge part of that. Derogatory credit will make it harder to get approved in general. It will make it harder to get approved if you have lower income. It will make every aspect of the process a little harder, which is why it's so important to maintain good credit and to understand how credit works and how it affects those decisions.
So, I mean, I guess people don't really understand how important it is to have good credit, especially
Mhm.
when purchasing a home. Can do, talk a little bit about your experience from what you've seen, relatively speaking, from the interest to payment, and as it relates to a credit score, whether it's a great credit score, great interest rate, great payment, versus not so good credit score, not so good monthly payment.
Absolutely. The credit, the rates, the way interest rates work, there's 20 point buckets, I guess I'd say. So at the top, you'd have somebody maybe with a 760 or 780. Anything above 760 for most programs is pristine, it's perfect. So as long as you're a 760, whether you're a 762 or an 803, doesn't really matter. You're going to get the lowest possible rate. Every 20 points on your credit, going to 740, going to 720, going to 700, going to 680. Every 20 points means you're going to have a higher interest rate. A higher
Hmm.
interest rate, every 20 points lower means your interest rate is going to go up. A higher interest rate means you're going to have a higher payment. An important part of the underwriting process for mortgage approvals is called the debt ratio, which is your gross income divided into your gross debt. In really round terms, if your gross income is $6,000 a month, your total debt is $3,000 a month, your debt ratio is 50. So the higher the mortgage rate goes up, the harder it's going to get approved. The harder it's going to be to get approved.
Right. And so, why do you think that it would be better for someone to work on their credit? Say they're ready now,
Mhm.
and with how the market is and the conditions, do you recommend someone that if they haven't found their house or their investment property, take more time to work on their credit rather than just kind of jumping the gun?
Absolutely. It is tough to convince people that, because people will say to me, I'll lay out a situation where I'll say, listen, based on your credit now, based on your income now, here's the most you can afford. Here's what your down payment needs to be. If you brought your credit score up, say, to 640, to 680, to 660, you'd be able to qualify for this. You'd be able to qualify for a lower down payment. And invariably, people say they want to wait, but then they'll start looking. One of the things I say to people is, listen, don't start looking until you're ready to buy, because
Right.
you will fall in love with something, you will want to jump the gun, and your carefully laid plans will kind of go sideways.
Oh
Uh,
man,
it really
terrible.
depends. Yeah, I see it all the time, but I will break it down so they know exactly what they can do now and exactly what they can do in the future. Listen, you're always better off being in a position where you're going to get a lower rate, you're going to have lower monthly expenses, you're going to have more disposable income, you're going to have more money to invest for your savings and for your long term. It's always better to do that. But of course, what's the market going to do? In a rising rate environment, or an environment where house prices keep going up, you can always refinance down the road. But once you negotiate the additional price for the house, that's kind of set in stone. So every situation's different. Look, at a perfect world, I'd want to help everybody get to a point where
Of
they can
course.
qualify for the lowest possible rate. But in life, there are a lot of other factors that happen.
And there's always these clever ways how people find friends or family to kind of put the mortgage in their name, and they do these kind of things. Is
Mhm.
that frowned upon in the mortgage industry? Or I mean, if they're both going to reside there, for people who are trying to get clever, they may have the income or the money right now, but their
Mhm.
credit wise they're not. So what do you say?
That's a great question. So people talk about co-borrowers. There's a co-borrower that's going to buy the property with you. They're going to live there. Then there's something called a non-occupied co-borrower, or maybe just a co-signer, where the person is only signing so you can use their credit and their income to help you qualify. Now, if there are two or three or four or five borrowers on a loan, the credit score that's going to impact the rate is always going to be the lowest one out of the five. So all of us ideally have three credit scores: TransUnion, Experian, Equifax. The underwriter, actually the computer, is going to look at those three scores. They're going to take the numeric middle. So if you have several borrowers, it's always going to be the lowest numeric middle score. So a co-borrower is really only going to help you in terms of qualifying for income.
Hmm.
Now, if somebody's buying the house and you're going to live there, if they're buying it as an investment property and they're going to rent it back to you, and then eventually you might buy it from them down the road, there's nothing wrong with that. What is frowned upon is Joe saying he's buying it as a primary residence, but he has no intention of living there. He has the income and the credit, but his brother Steve, who doesn't have the income and the credit, is going to live there. That's crossing that line where it becomes considered mortgage fraud. You don't ever want to do that. If it's discovered, bad things happen. They'll call the loan. They'll say, okay, you have to pay us this $400,000, in 30 days. So again, another reason why it's very important to work with professionals who will understand your situation and tell you the best way that you can get to your goal without crossing that line and doing something you don't want to do.
And like, what would that cost you? What are some like ramifications if someone's trying to play that thin line?
Well, if it's an FHA loan, and as you know, many people, because FHA loans are easier to qualify for, many
Right.
people who have a limited income or credit issues are going to end up with an FHA loan. The credit scores go much lower. In some cases, as low as as low as 500. I've done FHA loans for people in the low 500s. Believe it or not, not easy, but we get it done. And also FHA loans traditionally is a low down payment. Many FHA borrowers qualify for 3.5% down payment. However, FHA loans are guaranteed by the federal government, by the Federal Housing Administration. So if you cross that line on an FHA loan, technically you're defrauding the government. You can go to jail.
Mm,
So again, it's something you want to talk to a professional. You want to find the best way to reach your goal without getting in a situation like that. Conventional loans, which are loans uh, from private companies, big lenders, huge companies, many of them owned by hedge funds, they're not
right.
guaranteed by the government. If they discovered something like that, they would want you to pay that loan off. They want to get that loan off their books. They don't want to
Right.
be carrying that loan if it was closed under the auspices of a primary residence, owner occupied, and ended up being somebody else's house. And maybe you're actually renting it from them or whatever arrangement you've worked out.
It's terrible, right? And we're talking if you need a co-borrower or you're going the difference between FHA and conventional, right?
Mhm.
And your credit score is not at that 680, 660 realm.
Right.
And especially if you don't have your down payment, I don't want you to be discouraged. Hey, I think that right now you should be preparing yourself now more than ever.
Absolutely.
As a financial coach, I just want to give some advice, right, for those that are watching. If you have any accounts that, let's say you have good credit, but high credit card balance, and
Hmm.
perfect case, you have a $18,000, balance with Bank of America.
Right.
You're paying 29% interest.
Right. It's
Sometimes
crazy.
people are trying to figure out, okay, look, I can't get out of this debt. What am I supposed to do?
Right.
Well, do a budget plan. Find
Right.
out how much you're actually paying towards the interest,
Hmm.
how much you're paying towards principal.
Hmm.
And from there, I recommend say, look, when you're submitting that loan application and they see that too many credit cards have a balance,
Right.
it's an easy decline reason.
Yes.
If your utilization is over 30 or 50%, it's a
Correct.
decline reason,
Right.
right, folks? So what we're talking about obviously is, Money Monday, and we're talking about how to prepare you in this market that we're in for real estate. Kevin, what are some crazy stuff you've seen as far as like over asking price?
Oh gosh. I recently had a closing. Well, it hasn't closed yet. It was in River Edge. It was a $649,000 dated colonial. It was a good size home. It was 4 bedrooms, 2 bathrooms. It was built probably in the 1950s. It had been updated about 30 years ago. It was listing, I believe, for 649. It sold for 807. So
Wow.
I've seen a lot like that. I've seen things in the mid eights going for the low millions. Um, it's surprising, and one of the things from my perspective, when somebody enters a contract like that, what you don't know is if the appraisal is going to come out to equal the purchase price.
True.
Because just because somebody's willing to pay a certain amount of money for a home doesn't mean that the previous market sales support that value. But there have been surprisingly few appraisal issues, which tells me we're still in a rising property value environment. So the appraisers feel confident and comfortable issuing that appraised value to match the purchase price of that home.
That's very interesting, right? Because what happens if you don't? What if that appraisal doesn't come in and you still want to buy that home? Who's going to have
You,
to come out of pocket?
you always have the option to take it out of pocket. The other thing is a lot of it has to do with the way the contract was written. So what a lot of people are doing is, I had one today where the realtor asked me to revise my pre-approval and say that the borrower had excess liquid funds to cover any appraisal shortfall. So the standard contract has what's called an appraisal contingency, which means that if the house does not appraise for the purchase price, the buyer has the option to walk away from the contract with no penalty. What I'm seeing is people waiving that contingency to make their offer more acceptable, or they'll put in a limit. Say, hey, the list price was 650. I'm offering 700. As long as it appraises for at least 675, I will make up the difference. But yes, that difference between the purchase price and the appraisal comes directly out of the buyer's pocket unless they qualify for a higher percentage, what's called loan to value. So maybe they're at 80% loan to value, meaning they're putting down 20%. However, under appraises, maybe they qualify for a 90% loan to value. So now they're putting down 10%. So even though the value is less, the bank's decision is always going to be based on the lesser of the appraised value of the purchase price.
Right.
So just because it under appraises does not mean that the deal can't go through, even if the buyer doesn't have the additional funds. There's a lot of moving parts. Again, so important to work with a professional person, as far as working your budget, making sure you're not going to be house poor, a mortgage professional who can give you the options, make sure you don't get into any trouble, a real estate professional who knows how to present your offer to the listing agent in the most positive way possible. All always important, more important than ever in this type of market.
Absolutely. Kevin, real quick, what's a fun fact?
Well, my birthday's in about a month, and a fun fact is my buddies always take me out for. We're very into food. They take me out for something called omakase,
Okay.
which is chef's choice sushi, and we go to a place on the Lower East Side, and I eat fun things like sea bream, fluke, uh, sawara raw scallops, which kind of grosses some people out. They take a wagyu beef and they torch it up a little bit, and they put some goose pate on it. So that's something I'm looking forward to very much. You get about 15 to 20 different things. You sit there, the chef makes it right in front of you. They tell you what they're making. They tell you what part of the world it comes from. A lot of it comes directly from Japan. That's something I enjoy doing very much, and I'm looking forward to it. It's a couple of weeks away.
That sounds great. I really appreciate you sharing that fun fact with us and coming on to talk about this on Money Monday. And as we always do, we like to kind of finish our show with a final thought. So, Kevin, what are some of your final thoughts?
Again, I think people underestimate, and I know I've mentioned this a couple of times, I think people underestimate how important it is to work with an experienced mortgage professional, an experienced real estate agent, to have their ducks in a row. I love what you do in creating that budget plan, because people assume that banks are very restrictive on what they'll approve you for. The reality is, even in the current environment, banks will approve people probably for more money than they want to spend on a monthly basis. So the question should not be, what's the most I can get approved for? The question should be, what is the monthly payment I want that'll fit my lifestyle and my budget plan? And I love what you do, because you create a realistic expectation. Look, you just don't want to be in the house. Every last dime goes to paying that mortgage. You want to send your kids to college. You want to have a comfortable retirement, and setting those parameters, which people really usually don't have any instruction on that when they're younger. That's so important. So getting trusted professionals involved at the beginning is huge. It's everything, really. It makes all the difference, in my opinion.
I agree 100%. And, as a financial coach, my goal is always to inspire, connect, and educate and provide value, massive value. I hope that you received some value today for watching this. As the quote of the show goes, if you fail to plan, you plan to fail. Go in grace, go in peace. Kevin, don't go anywhere. Hang out with me in the afterglow.
Thank you for having me.
Questions, please feel free. Kevin, how can they contact you?
Well, anybody can call my cell, 201-906-1177, 201-906-1177. Homeland Lending is the website, homelandlending.com. I'm on there. My email's on there. My cell's on there. If you Google my name, I'm easy to find.
Awesome. Well, if you have any questions and you were watching live, please #live. And if you're watching on the replay, please #replay. Tag a couple of friends that might need some credit assistance or that are looking to purchase or invest in real estate this year. Again, this is Anthony Rosa, Mr. Remedy, the community finance coach. Peace.